Welcome to The Explainer. Right now, there are two completely different stories being told about the market. And, well, they can't both be right. So let's dig in and figure out what's really going on.
On the one hand, all you hear about is this rising anxiety, this growing sense of caution. But then you look at the data, and you see incredible economic and corporate strength. So, which story is it? Are investors genuinely scared, or is the market actually fundamentally strong?
This slide just lays out the whole puzzle perfectly. I mean, look at this. In one corner, you've got fear indicators flashing bright red. Tech stock anxiety is at a one-year peak. But in the other corner, you have the fundamentals for the broader market looking better than they have in over a decade. Okay, let's dive into this.
First, let's really unpack the case for fear. To do that, we got to understand how professional investors actually measure it.
The key concept here is something called implied volatility. Now, the easiest way to think about it is like the market's collective pulse, or its heart rate. When that pulse is high, it means investors are paying more for insurance, in this case options, because they're bracing for bigger price swings. It's a direct read on just how much uncertainty is out there.
So this number, 7.3%, this is where things get really interesting. This represents the difference in expected volatility between the tech-heavy NASDAQ and the broader S&P 500. You can think of it as a fear gap between tech and everybody else.
And that 7.3% isn't just some random number. It's a huge signal. It's telling us that investors are feeling a very specific anxiety, and it's focused squarely on the tech sector. It's likely all about those high valuations and maybe some worries about the future of the AI boom. And hey, it's not just that one tech spread. The VIX index, that's the main fear gauge for the entire market, is up. We're also seeing way more investors buying puts, which are basically insurance policies that pay out if prices fall. It all points to a real pickup in short-term defensive moves.
But hold on, that's only half the story. The anxiety is definitely real, but it's running headfirst into a wall of incredibly strong data. So let's flip the coin and look at the powerful counter-narrative being built on pure fundamentals.
Now, this number is every bit as important as the last one we saw, 13.1%. That is the net profit margin for companies in the S&P 500 this past quarter. Not only is that a huge number, it is the highest level we have seen in over 15 years. And it's not just about the margins. I mean, look at this performance. 82% of companies beat their earnings estimates. 76% beat revenue. In every single key metric, corporate America is just blowing past its own long-term averages, and they're doing it despite a pretty challenging global backdrop.
So this leads to a really crucial point, which is that this isn't just good news. It's a justification. These record profits give a strong, fundamental reason for why stock valuations are where they are today. The market isn't just running on hype, it's being supported by historic profitability. This chart right here really puts it all into perspective. So yes, the market's current valuation of 22.4 times earnings, that is above its 5- and 10-year averages. But like we just saw, it's being supported by record-breaking profitability that is also way above its historical average. So the two go hand in hand. Okay, but I can hear the skeptics, right? What if there's a hidden problem lurking beneath the surface? Well, to check for that, we can look at one of the most sensitive indicators out there, the corporate bond market. And you know what? It's telling a very clear story of confidence. So what you're seeing here are spreads. Think of it as the risk premium, the extra slice of yield that investors demand to hold a corporate bond instead of a super safe government bond. When that premium is high, investors are worried. Right now, it is significantly below average. That tells us that these typically cautious investors see very little risk of economic trouble on the horizon.
Now, this tension between short-term fear and long-term strength, it might feel new, but it's really not. In fact, if we look back, history gives us a powerful and frankly fascinating parallel.
Just check out this setup from the mid-1990s bull market and compare it to today. It's wild. In both cases, you have a major interest rate shock from the Fed, and then, almost immediately, the explosion of a new, disruptive technology that just completely captures the market's imagination.
So it's one thing for the starting points to be similar, right? But what's truly astonishing is how the market's performance has basically tracked that 1990s playbook ever since.
I mean, just look at these numbers. We are 724 trading days into the current rally. The performance of the NASDAQ today is nearly identical to the path of the dot-com boom at the exact same stage. The similarity is just uncanny.
And here's the really important part. the journey wasn't a straight line back then either, not at all. It was characterized by the same kind of sharp pullbacks, the same worries about high valuations, remember irrational exuberance? And the same uncertainty we're all feeling today. This feeling of anxiety, it's part of the pattern.
So how do we put all this together? How do we resolve this conflict between the fear we feel and the fundamentals we can see? It all comes down to a classic, old-school market concept.
It's called the wall of worry. And this isn't about ignoring risks, it's about recognizing that the most powerful bull markets are often forged in an environment of doubt. They climb higher because they keep overcoming the things investors are worried about.
And the 90s playbook shows exactly how this works. A big scare hits, like the Asian financial crisis, and it causes a sharp pullback. But then confidence returns. The market doesn't just recover, it moves even higher. These periods of anxiety were just temporary obstacles in a much longer trend, not the end of the story.
So the crucial takeaway here is that the fear we see today, the tech anxiety, the tactical hedging, it isn't necessarily a sign that the party is over. Instead, it fits a historical pattern of a healthy, strong market climbing that proverbial wall of worry.
And that leaves us with a really provocative final thought. In the 1990s, every single one of these scary pullbacks ultimately proved to be a buying opportunity within a much larger bull market. Now, history never repeats itself exactly, but it often rhymes. So the real question isn't whether there's fear in the market, there always is, but whether that fear is a warning sign or just another brick in the wall of worry.